Okay, so the consumer price index report came out early this morning at 8:30, showing the numbers coming in really more with expectations, not quite getting what we wanted with a month over month core CPI number of zero point 0.2. It came in at 0.3, but that was the expectations of the market in general. So we're going to take a look and see a little bit more about that report, then take a look at where the charts are, and then where home loan interest rates are after the report came in at expectations, as well as what is to come on our next of the big three items that we're looking at. So let's take a look here quickly. The inflation rate fell again in December. Now, again, the inflation rate fell. I'm going to get into that a little bit further here in just a minute, to 6.5% on an annual basis. That's the headline number. That's not the core number. That's the headline number. And it says that's down from 7.1 in November. So that's a big drop. That is 0.6% drop in 1 month. And remember, look at this right here. It was at 9.1% in June. So we are now at 6.5 versus 9.1. Do we think inflation is subsiding? I mean, how can you deny going from a 9.1 to a 6.5? Now, look over here. This is one of the chief economists at Moody's Analytics says, I don't think that people will be talking about inflation this time next year. I mean, that's pretty strong, saying that a year from now, no one's going to be talking about inflation. When we were talking about it being at a 40-year high all of 2022, or towards the second half of 2022, those are big comments to be made and really lean towards our expectations of inflation continuing to come down. Well, let's take a look, like we always like to, at the actual report itself. So this is from the U.S. Bureau of Labor Statistics, the Consumer Price Index that came out today. And it says CPI for all items fell 0.1%. Okay, so it fell. So the headline number actually showed deflation. It was lower. The cost of those items actually was lower by 0.1%, which is quite a surprise. Let's take a look here a little bit further at where it says over the last 12 months, the index for all items less food and energy. Okay, so that's the core number for CPI, increased 0.3 in December, okay, and was up 5.7% year over year. All right, so when people read something like that, they go, why are we happy? Inflation is up 5.7%. It's up 0.3% month over month, because we understand that, look, inflation isn't just going to disappear. It needs to slow down. So when we see it going to a 5.7% year over year on the core CPI, where it was 6.0% last month, we see the curve coming back down. We can't go from 5.7% consumer price index on our core reading at, and drop down to zero. So we can't go from 5.7 to zero. We have to slowly go down 5.7, 5.4, 5.0 to get down to ultimately where the true reading that the Federal Reserve wants to see is that it is at 2% year over year. So we have a ways to go before they're really going to be happy and they're going to feel like they have done their job of bringing inflation under control. But this report definitely is helpful for us because it didn't come in higher than the market's expectations, but we wanted to come in a little bit lower at a 0.2% month over month on the core reading. So let's take a look and see where our charts are. Right now, we are up 31 basis points. Now, this has gone up and down today as the information in the report has been digested. It came out actually jumping out a little bit higher. It came out in the positive, but then it went back down and went negative for a little while, and now we're up 31. So as the market has digested this information, we're in a pretty good position on our mortgage-backed security. Again, I really like to see this over here, the 10-year Treasury down 11 points on the yield. Okay, now I know that a lot of people don't want to see that, people that are making their income based on this type of a Treasury, but we like to see that from a home loan interest rate perspective. So let's take a little bit further down on the chart here. We talked about that we needed to break out of this little area that we were in with the 25-day moving average as the floor and the Fibonacci level as the ceiling. We bounced around here pretty much all day, but here at the end of the day, we got only about 5 minutes or 8 minutes left in the trading day. It seems like we might close above this Fibonacci level and hopefully begin able to make that a floor of support under us as we gear up and get ready to break through the 200-day moving average, which we have not really been fighting with for a very long time, over a year. Okay, so the next report that's going to be coming out is the personal consumption expenditure. It's going to be coming out on January the 27th. We are expecting more fireworks from this report than we did from the consumer price index. We really like what we think is coming on the PCE and believe that we'll be banging up against or possibly breaking through that 200-day moving average. And let me show you where we are right now and what that would do for us. On our Brent Bruce daily home loan interest rates right now, let's take a look at this scenario of our very well qualified 30-year fixed conventional home loan. Again, this is with my company, Rancho Capital, probably lower interest rates than you're going to see anywhere else. But this is where we are, 5.999. Okay, so like we talked about, we needed a pretty good report. Hopefully we wanted the 0.2, but we got the 0.3 on the month-over-month core reading. But the market's liked it enough that we're now at 5.999 with a credit of 1,271, which is good to see. Let's open this up a little bit further and see what would happen if we were going to pay a point. So if someone were to pay not even a point, not even up to a point, just under that, they're at 5.5, guys. 5.5% on a conventional 30-year fixed mortgage for less than a point in discount points. And we know that right now sellers are willing to pay that. So if you're not telling your clients that we could possibly get you in the mid fives, if they're very well qualified, you're missing the boat. We have that here. Most don't, but we do. Reach out to us and let's see if we can get your client to feel more comfortable moving forward if they've been a little bit resistant to that previously. So here you can see if someone were to pay that 1 point about, they're at 5.5%. Let's take a quick look at the parameter. So here we are. This is showing the parameters. Again, very well qualified, 30-year fixed conventional home loan, 800 FICO score. Now, again, if we get that report from the PCE like we want, and if we start battling with or possibly break through the 200-day moving average, what do we think is going to happen to our actual interest rates? I'm going to show you right now. So if that were to happen, I think that 5.5% possibly will be with no points. And then if you were to pay a point, you could be looking at 5.25 to 5.125. Now, here's the thing. If that is the case, and we are at 5.5% with no points in the month of January, look at how well positioned. We are only, a 0.5% away from getting back into the fours, guys. And that is why I've made the predictions and projections that I have. So far, the CPI report, which is one of the big three, shows inflation continuing to subside, going from 6.0 to 5.7 on the core reading and going from 7.1 to 6.5% on the year-over-year headline reading. Great news for us today and definitely playing into our expectations. I will get back with you tomorrow and let you know how things flow through as this information is continuing to be digested. Let me know your thoughts. Make sure that you like, subscribe, and share, and I will get back to you again tomorrow.